Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Jumia Technologies.
If you find our talks useful, please consider subscribe, like, and comment underneath. We really appreciate the support.
We do.
Now stick with us, because today we are looking at a ticker that just reported earnings, and honestly, it has created one of those classic confusing market moments that we absolutely love to untangle.
Oh, yeah.
We are analyzing Jumia right on the heels of their Q4 2025 earnings report, which just dropped on February 10th.
It is a fascinating setup. You have what looks like this, incredible turnaround story on one hand.
Right.
And then a stock chart that looked like it just tripped down the stairs on the other.
Yeah.
It's a real head-scratcher at first glance.
Exactly. It feels like a textbook good news, bad price action situation. I was reading the print this morning, and the company posted really strong growth numbers. I mean, arguably their best in years.
Sure.
But then I pull up the chart, and the stock took a hit. It gapped down significantly in pre-market. So the mission for today is pretty simple. Is this a red flag telling us to run for the hills?
Or is it something else?
Or is this a buying opportunity disguised as a market overreaction?
To answer that, we have to look past the big red % sign on the dashboard. We really need to understand the mechanics of what's changing in the business. Because the disconnect between Jumia's performance and the stock's performance is, well, it's wider than I've seen in a long time.
Then let's get into the machinery. Let's start with the headline numbers. What did Jumia actually deliver in Q4 that has the bulls so excited despite the price drop?
Well, if you look at the top line, they didn't just meet the bar, they cleared it. Jumia reported Q4 2025 revenue of $61.4 million.
Okay, $61.4 million.
And for context, that is a 34% increase year over year.
34%.
Compared to the $45.7 million they did previously. And importantly for Wall Street, it beat the analyst estimates, which were sitting roughly around $60.6 million.
Okay, so a 34% jump in revenue is legitimate growth, especially for a company that was, struggling with identity issues a few years ago.
Oh, definitely.
But revenue can be tricky with e-commerce, right? We always talk about GMV, gross merchandise value, when we analyze these marketplaces.
Absolutely.
Because revenue is just their cut, but GMV is the actual economy of the platform. How much stuff is moving through their pipes.
That is the metric. It really tells you about the health of the ecosystem. You are spot on.
Right.
Revenue can be tweaked with fee changes, but GMV, that's the raw demand. And this is where the story gets even better. Their GMV accelerated to $279.5 million. That's a 37% increase.
Hang on, let me parse that.
Yep.
So the volume of goods being sold, the GMV is growing faster than the revenue. That implies the engine is running hot. It means people are buying more, regardless of how Jumia monetizes it. That feels like a very bullish signal for the underlying health of the consumer.
Precisely.
Right.
And if you break down the composition of that revenue, it shows a healthy mix. You have their marketplace revenue.
Which is the fees from third-party sellers.
Right, exactly. That grew 36% to $31 million. But then you also have their first-party sales. The inventory Jumia buys and sells themselves, growing 33% to nearly $30 million.
So it's not just one lopsided part of the business carrying the weight. Both the platform side and the retailer side are firing.
They are.
But here is the skeptical question I always have with these emerging marketplaces. Is this just inflation, or are actual human beings using the platform more?
That is the right question to ask. In high inflation environments, revenue can go up even if you sell fewer items.
Exactly.
But the data here shows it is volume driven. Their active customer base grew by 26%. They've now hit 3 million active customers.
3 million.
And the real kicker, physical goods orders were up 32%, hitting 7.5 million orders in the quarter.
7.5 million orders. We've heard the Amazon of Africa narrative for probably a decade now.
A long time, yeah.
And for a lot of that time, it felt like a marketing slogan to sell IPO shares. A great pitch, but the reality was messy. But when you see 7.5 million physical orders in a single quarter, that feels like that narrative is finally showing actual kinetic momentum.
It is moving from potential to reality.
Right.
They're proving that the demand is there and that the habit is forming. You don't get to 7.5 million orders by accident.
Well,
that is recurring behavior.
But let's zoom in on the map. Africa is a massive continent, 54 countries. It is not a monolith. I have to imagine this growth isn't happening everywhere all at once.
No, you're absolutely right. It's not uniform at all. The growth is being driven by specific regional powerhouses.
Like where?
If you look at Nigeria, which is obviously a critical market, largest economy, largest population, they saw 50% GMV growth.
50%. That is massive.
It is huge. And then you look at Ghana, and they saw a staggering 124% growth in physical goods GMV.
124% is hyper-growth territory, doubling and then some. What is driving that? Is it just that there are no other options?
It's a mix of necessity and strategy. In these core markets, the adoption curve is going vertical because traditional retail is so fragmented.
Right.
But a big part of this is Jumia actively improving the digital infrastructure. For instance, their partnership with Starlink in Nigeria and Kenya is a key driver here.
Oh, right. I saw the headline about Starlink, the high-speed satellite internet. But connect the dots for me. Why does a partnership with Starlink specifically help Jumia sell more, blenders and sneakers?
Think about it like building a highway. Before you can sell cars, you need a road.
Oh, okay.
In e-commerce, the road is the internet connection. If the connection is slow or unreliable, people don't browse and they certainly don't transact. Starlink bridges that gap.
So it literally opens up the market.
Exactly. Better, more reliable internet directly correlates to higher e-commerce penetration. But secondly, and maybe more importantly for the stock, the partnership signals to the consumer that Jumia is the high-tech premium option.
Ah, it's a branding halo.
It widens the gap between Jumia and its competitors, yes. It associates them with cutting-edge tech.
That makes sense.
And this leads us to the concept of the moat. In markets like Nigeria and Ghana, Jumia is building network effects that are becoming very hard to break.
Right. Let's unpack that. Seller-buyer liquidity.
Well, when you have 3 million customers and 7.5 million orders flowing through your system.
If I'm a seller in Lagos, I have to be on Jumia because that's where the buyers are.
Precisely. It's the chicken and egg problem. Solved. Local rivals, and there are some like Takalot or Gigi, they just struggle to match that sheer volume in Jumia's core regions.
And they don't have the physical infrastructure either, I'd imagine.
That's the other part of the moat. The logistics for last-mile delivery. The motorcycles, the warehouses, the pickup points, you can't just code that overnight.
Okay, so the top line is great, growth is explosive, the moat is digging deeper, but we have to pivot to the ugly part of the history. The question that always comes up, are they making any money?
The profitability question.
Or is this what they call profitless prosperity? Because for a long time, Jumia was burning cash like it was going out of style.
And this is where the narrative shifts from growth at all costs to the profitability pivot. And honestly, the data from Q4 is actually very encouraging on this front.
Encouraging how? Lay it on me. How bad were the losses?
They are getting much, much better. Their adjusted EBITDA loss, it narrowed by 47%. It came in at a loss of just $7.3 million.
Wait, only $7.3 million? I remember a few years ago they were losing 10 times that in a quarter.
Exactly. I mean, even compared to the previous period where it was $13.7 million, cutting that loss almost in half is a massive step change.
So it's not just accounting magic.
No, it's coming from real operational efficiency. They aren't just selling more, they're operating smarter.
Give me an example of that efficiency. What are they doing differently?
Look at their fulfillment costs. This is usually the killer for e-commerce. Their fulfillment cost per order dropped 12%. It now costs them just $2 to fulfill an order.
$2 to order. That is incredibly lean. I mean, think about the logistics of moving a package across Lagos. Doing that for $2 is impressive.
It is. So think about the math. Volume is up, costs are down. That is the classic recipe for expanding margins. Their gross profit was up 43%, with margins improving to 12.2%.
So the trend lines are converging, but when do they actually stop losing money entirely? Is there a date on the calendar, or is it still someday?
Management has been surprisingly clear on the timeline. They are guiding for break-even and positive cash flow by Q4 2026.
The end of this year.
The end of this year, and then full profitability in 2027.
Okay, so we are looking at roughly 10 to 12 months until they cross that line. But that brings up the survival question. Do they have enough cash in the bank to get there?
This is the most crucial point for anyone worried about dilution. Jumia has $76.7 million in cash and roughly $77.8 million in total liquidity.
$77 million in the bank. And they lost about $7 million in EBITDA. Okay, I can do that math.
But it gets better. Look at the cash used in operations. It was only $1.7 million in the quarter.
Wait, hold on. They only burned $1.7 million of actual cash. How is that possible if the EBITDA loss was 7 million?
Positive working capital dynamics. Essentially, they're collecting money from customers faster than they have to pay their suppliers. It's the Amazon model.
So if they're only burning roughly 2 million of cash a quarter and they have 77 million in the bank,
Then the math is simple. They have years of runway. They aren't burning cash at a dangerous rate anymore.
that is a game changer. That takes the going to zero risk off the table for the immediate future.
Absolutely. The liquidity profile is safe.
Okay, so let's recap the bull case. Revenue up 34%, GMV up 37%. Losses cut in half. Cash burn is tiny, they have plenty of cash. And yet,
And yet.
the stock dropped. Down 15%, hitting around 1075. Why? What did the market see that we are missing?
It comes down to expectations and time horizons. The market is a voting machine in the short run, right? While the revenue beat was great, they did miss on earnings per share, EPS. The loss was -8 cents versus the estimated -5 cents.
Ah, the classic EPS miss. So they lost 3 cents more per share than the algorithm guessed.
Exactly. And in this market, algorithms sell first and ask questions later. But there was also some anxiety around the guidance. Management guided for a full year 2026 adjusted EBITDA loss of about 25 to 30 million.
I see. So even though they are targeting break even by Q4, the full year implies they'll still be losing money in Q1, Q2, and Q3. And I guess some investors were hoping for a faster turnaround.
That's likely part of it. The market is impatient. They want profitability now, not in Q4. And there's also the noise around their market exits.
Right, shrinking the footprint, exiting Algeria, Tunisia, and South Africa, which is a big economy to leave.
It is huge, and there's a bear view on this. Exiting markets causes a short-term drag on GMV. You're literally turning off revenue streams.
It looks like a retreat. It looks like weakness.
To a bear, yes.
Yeah.
But the bull view, and the one management is pitching, is that these markets were not the profit centers. By exiting them, it allows Jumia to focus all its resources on the high-growth markets.
It's the shrink-to-grow strategy, like pruning a tree.
Precisely. But on earnings day, the market often focuses on the shrink part and ignores the grow potential that comes after.
So let's look at the technicals. We have this drop. Is the stop broken, or is this just a flesh wound?
I think if you look at the price action, it looks like a coiled spring. The sharp drop in pre-market feels like an overreaction, a shakeout of weak hands who just saw the EPS miss and bailed.
A shakeout. The uncommitted sellers just capitulated.
Exactly. And the news sentiment scores are currently sitting at neutral. There's no euphoric buying, which is actually good, but there's no catastrophic bad news structurally.
So it's volatile, but not toxic.
Right. The gap down reflects volatility around the earnings event.
Right.
But if you look under the hood at that GMV acceleration, it suggests momentum is building under the surface.
What should we be watching for next? What are the catalysts that could make the stock bounce back?
Well, the formal exit from Algeria is happening this month, so that noise will be behind them. And then we have Q1 earnings in May. If they can show another quarter of 30% plus growth while cutting losses,
The market will be forced to pay attention.
they can ignore one good quarter, but they can't ignore a trend.
Okay, let's bring this home. We've looked at the growth, the profits, the risks, the chart. I need your verdict on Jumia.
Taking everything into account, I give this a bullish score of 8 out of 10.
An 8 out of 10. That is pretty high confidence given the stock just dropped 15%. Walk us through the thesis one last time.
The thesis is simple but robust. First, the growth. Revenue and GMV are accelerating at over 30%. You rarely find that at this scale.
And it's on sale.
And the stock is beaten down. Second, the efficiency. Losses are narrowing by almost 50%. They are proving the economics work. And third, the safety net.
The liquidity.
The liquidity is safe. $78 million versus a very low burn rate. This market drop provides a really compelling entry point for a swing trade or even a long-term hold.
It does feel like a discount. And you mentioned something earlier about stickiness. That really stuck with
Yes,
me.
the repurchase rate. It increased to 45.7%. That means nearly half of their customers are coming back to buy again. That proves the service is essential. It's not just a novelty.
People rely on it.
And that's the foundation of a long-term business.
Sure.
The strategy here is seeing this as a turnaround play. The exit of non-core markets clears the path for that 2027 profitability inflection.
That is a very compelling picture. You know, it's funny, looking at the macro picture, Africa has had a rough go with currency fluctuations.
For a few years, yeah.
But we are seeing consumer spending rotating and currency stabilizing, like in Egypt recently. That's a huge tailwind.
A macro tailwind helps immensely. When currencies stabilize, these businesses suddenly look much more attractive in dollar terms.
It really does. And if Jumia is positioned as the primary infrastructure for commerce in the region, I mean, think about it. If they hit that Q4 2026 break even and they are the dominant player in a stabilizing, growing continent with 1 billion people, where does the stock go from here?
That's the potential upside that makes the risk worth considering.
It feels like the ceiling is much higher than where we are today.
You're betting on the digitalization of a continent.
Well, there you have it. A deep look into Jumia's latest numbers. Volatile, yes, but growing like a weed, absolutely.
A fascinating setup for the rest of 2026.
Thank you for listening to Smart Wealth with Joshua. We'll be back tomorrow with another deep dive into the markets. Until then, happy investing.
Goodbye, everyone.